Welcome to the Mind Spark, your source for breaking news and trending stories from around the world. Imagine waking up, heading to the ATM and seeing transaction denied. You try again. Same result. Panic sets in. Your banking app won't load. The bank's phone lines are jammed. This isn't a glitch, it's nationwide. The cause? Your country's largest bank has been frozen out of the global financial system. Cut off. Isolated. All because of a decision made in Washington, D.C. This isn't Hollywood fiction. It's the reality of modern economic warfare. A financial Pearl Harbor that can cripple a nation without a single shot. The impact is instant international trade halts. Businesses can't pay suppliers, the currency crashes, and families abroad can't send money home. The entire economy sputters to a stop in hours. This is the power the U.S. wields through its control of the dollar, the world's economic lifeblood. Increasingly, the U.S. uses this power to send a clear message. Play by our rules, or be unplugged from the world. This is no longer a distant threat. It's a sword of Damocles over every international bank. The warning is explicit. Any bank facilitating major transactions with adversaries like China or Iran risks being excommunicated from the U.S. financial system. This isn't about fines, it's about financial annihilation, a corporate death sentence delivered by the U.S. Treasury. Boardrooms from Frankfurt to Singapore are on edge. Bankers face an impossible choice: abandon business with China, or risk losing access to the U.S. dollar, essential for global operations. It's a choice between bad and worse, a geopolitical tightrope with no safety net. The tremors of this new economic Cold War are shaking the foundations of global finance. The aftershocks will be felt by everyone, from CEOs to the person just trying to buy coffee. The US dollar's dominance is both a shield and a weapon. As the world watches, the stakes have never been higher. The question is, how long can this power last before the world finds a way around it? The financial battlefield is set, and the first shots have already been fired. The era of economic warfare is here. Are we ready for the consequences? The US Treasury has issued a stark ultimatum: stop helping China and Iran bypass sanctions, or lose access to the US dollar. This isn't a suggestion, it's a command, enforced by America's economic might. Treasury officials are meeting global bankers behind closed doors, making it clear the era of looking the other way is over. The main target? Transactions with Iran settled in Chinese yuan, a loophole that lets Tehran sell oil and Beijing secure energy, all while dodging the dollar. Washington sees this as a direct threat and is determined to cut it off. Global banks are told, you can't be a bridge between the yuan and the dollar. Choose a side. For banks, the stakes are enormous. China is a massive market, but losing access to US dollar clearing would be fatal. It's a brutal dilemma. Billions in Chinese business, or survival in the global financial system. The US isn't just talking, it's acting. Smaller banks in the Middle East and Asia have already been named and shamed for facilitating yuan trades. These are warning shots to the bigger players. The US means business. Compliance teams are scrambling, risk models are being rewritten, and tough decisions are being made at the highest levels. The Treasury's ultimatum has drawn a new front line in the economic conflict between the US and China. Banks are caught in the crossfire, forced to pick a side in a battle that could reshape global finance. The world's financial system is being redrawn, one sanction at a time. The message is clear: the dollar's dominance is not to be challenged. But the dragon is rising, and the world is watching. The next move could change everything. The choice is no longer theoretical, it's happening now. The stakes? Nothing less than the future of global trade. The world's banks must decide, the dollar or the dragon, and there's no going back. What does it mean to lose access to US dollars? It's the financial equivalent of a nuclear option. The dollar is king, nearly 60% of global reserves, 90% of forex transactions. Trillions flow through New York daily. For international banks, dollar access is oxygen. Without it, a bank can't function globally. Payments stop, clients flee, credit lines vanish. Imagine a German car maker trying to pay a Mexican supplier. Even if the US isn't involved, the payment likely goes through a New York bank. If that bank is sanctioned, the deal collapses. Multiply that by millions of transactions. The sanctioned bank becomes a pariah, untouchable, isolated, dying overnight. The US Treasury's secondary sanctions freeze assets, cut off American partners, and devastate entire institutions. This power comes from America's central role in global finance. Once reserved for terrorists and rogue states, these tools now target major powers like China. The fear is real. Global banks are forced to act as arms of US foreign policy. Compliance costs soar. Every transaction is scrutinized for links to sanctioned entities. The rules can change overnight, adding uncertainty and risk. The cost of non-compliance isn't just a fine, it's existential. Banks must choose comply or risk being shut out of the global economy. The US wields this big stick, and every bank is watching. The message is clear: cross the line and you're out. The stakes are survival itself. The world's financial order is being enforced, one sanction at a time. The cost of defiance? Total isolation. The lesson? In the age of economic warfare, compliance is everything, and the price of failure is absolute. While Washington sharpens its financial weapons, Beijing is building an alternative. China isn't just resisting dollar dominance, it's creating a parallel financial universe. The goal: insulate itself and its partners from US pressure. The centerpiece? The internationalization of the yuan. China and Iran are leading the way. In 2023, China imported a record 1.1 million barrels of oil per day from Iran, paid in yuan, not dollars. This closed loop lets Iran buy Chinese goods, bypassing the US Treasury entirely. China is expanding this model to Russia, Brazil, and across Asia and Africa. The yuan's share of global payments is rising, and for the first time it's the top currency in China's own cross-border trade. China is systematically de-dollarizing, encouraging partners to do the same. The new Silk Road is paved with oil and yuan, not gold. China's cross-border interbank payment system, CIPS, is growing fast, offering a yuan-based alternative to SWIFT. Every transaction through CIPS is one less the US can control. China isn't just complaining, it's building an escape route. The yuan's rise is a direct challenge to the post-Woodian II financial order. The world is watching as China rewrites the rules. To grasp the scale of this clash, look at the numbers. The US is still the world's largest economy, over $28 trillion GDP, the deepest financial markets, and the dollar in nearly 90% of forex trades. This gives Washington unmatched leverage, cheap borrowing, powerful sanctions, and global influence. But China is closing in fast. Its GDP tops $19 trillion, and it's the world's largest trading nation. China is the top trading partner for over 140 countries, controlling vast supply chains and the flow of goods. The dilemma for global banks: choose between the US financial system or China's real economy. Both are essential. Energy is a key battleground. China is the world's largest oil importer, with record purchases from Iran and Russia, mostly in yuan or other non-dollar currencies. Tens of billions now flow outside the US system, chipping away at dollar dominance. The US is doubling down on financial power, enacting laws and sanctions to maintain control. China is building its own system, backed by over $3 trillion in reserves. Analysts say we're moving from a unipolar, dollar-dominated world to a multipolar currency era. The numbers prove it. This isn't theory, it's happening now. The global balance of power is shifting, and the consequences will be felt everywhere. The US and China are locked in a high-stakes economic duel. The outcome will shape the future of global finance. The world is watching and recalculating. The age of easy dominance is ending. This isn't just a game for bankers. These battles hit your wallet. Sanctions and tariffs create friction, raising costs that trickle down to consumers. Rerouted shipping, pricier suppliers, and disrupted supply chains mean higher prices for cars, phones, and even food. US companies face tough choices: absorb costs, move operations, or lose competitiveness. Tariffs and sanctions can scare off foreign investment, making the US less attractive and raising borrowing costs. Uncertainty slows business investment, hiring, and growth. The quest for financial dominance abroad could mean higher prices and slower growth at home. The economic conflict with China is already affecting American jobs and wallets. Experts are sounding the alarm. Weaponizing the dollar is a risky strategy. Overuse of sanctions teaches the world to live without the US. The IMF reports the dollar's share of global reserves is slipping, with more money moving into currencies like the yuan. Gita Gopinath of the IMF warns that a fragmented payment system could make the world poorer. Adam Posen of the Peterson Institute says the US is overplaying its hand, pushing even allies to seek alternatives. Allies in Europe and Asia are quietly hedging their bets, seeking more monetary autonomy. The warnings are urgent. Privilege abuse erodes the trust that underpins the dollar's dominance. If confidence in the US as a neutral steward fades, the search for alternatives will accelerate. The world's financial system runs on trust, and that trust is at risk. The tipping point may be closer than we think. What would a world less dependent on the dollar look like? It would be messy and fragmented. Multiple currency blocks, dollar, euro, yuan, could emerge, each with its own rules. Trade between blocks would be more complex and costly. China's CIPS, BRICS currency talks, and central bank digital currencies are all building blocks of this new order. Every new sanction is an ad for de-dollarization. Countries see it as economic self-defense. The era of a single, globalized financial market may be ending. The blueprints for a post-dollar world are being drawn now. If the world moves away from the dollar, the consequences for the US could be severe. Higher interest rates, soaring import costs, and lost sanction power would hit hard. America's global influence would shrink, and a power vacuum could emerge. Would a multipolar currency world be more stable or more chaotic? The answers will shape the future for billions. The US stands at a crossroads: double down on financial power, or adapt to a changing world. The stakes couldn't be higher. The world is watching, and waiting. As Washington tightens the screws on Beijing, the world doesn't just watch, it reacts. Across Europe, leaders weigh their alliances, balancing economic ties with China against security pacts with the US. In emerging markets, governments scramble to shield their economies from collateral damage, seeking new trade partners and alternative payment systems. Some countries double down on the dollar for safety, while others quietly diversify their reserves, hedging against uncertainty. International organizations call for calm, urging cooperation over confrontation. But in boardrooms and parliaments, the calculus is changing. Technology giants in Asia accelerate efforts to build independent financial infrastructure, while oil exporters consider pricing contracts in multiple currencies. Even traditional US allies begin to question whether the old rules still apply. This global game of adjustment and realignment sends ripples through markets, supply chains, and everyday lives. The world's response to American financial pressure isn't just a reaction, it's a catalyst, setting off a new era of economic diplomacy and competition. In this high-stakes landscape, adaptation isn't just an option, it's a necessity for nations and for individuals navigating the uncertain road ahead. As the world's economic giants clash, emerging markets find themselves caught in the crossfire, yet refusing to remain passive bystanders. From Southeast Asia to Latin America and Africa, these nations face a daunting challenge: how to protect their fragile growth while two superpowers reshape the rules of global trade. For some, the solution is to diversify. Countries like Brazil and India ramp up trade agreements with new partners, reducing their reliance on either Washington or Beijing. Others invest in local industries and digital infrastructure, striving for self-sufficiency and resilience against external shocks. Currency stability becomes a top priority. Central banks stock up on gold, accumulate a basket of foreign currencies, and experiment with regional payment networks to sidestep volatility tied to the dollar or yuan. In the financial capitals of Jakarta, Lagos, and Istanbul, policymakers weigh the risks of aligning too closely with one side, wary of sanctions or exclusion from vital markets. Meanwhile, local entrepreneurs see opportunity in uncertainty. Startups in fintech, logistics, and manufacturing pivot to serve new supply chains and tap into shifting global demand. Governments launch incentives for innovation, hoping that homegrown solutions can buffer their economies from geopolitical storms. But these strategies carry risks. The wrong move could invite retaliation, capital flight, or a sudden spike in borrowing costs. For millions, the stakes are personal rising prices, job uncertainties, and the pressure to adapt in a world where yesterday's certainties no longer hold. In this unfolding drama, emerging markets are not just spectators. They're key players, writing their own playbooks for survival and growth. Their choices today will shape not only their own futures but the balance of power in the global economy for years to come. As the traditional pillars of global finance tremble, an unlikely contender steps into the spotlight: digital currencies and alternative payment systems. For years, cryptocurrencies like Bitcoin and Ethereum were seen as speculative assets or tools for tech enthusiasts. But today they represent something far more significant: a potential escape route from the dominance of the dollar. Central banks in emerging and developed markets alike are racing to launch their own digital currencies, known as CBDCs. These government-backed coins promise faster, cheaper, and more secure transactions across borders, bypassing the need for dollar intermediaries. In parallel, decentralized finance, or DeFi, platforms are enabling peer-to-peer lending, trading, and payments without traditional banks or gatekeepers. Nations under sanctions, like Iran and Russia, experiment with crypto payments to keep trade flowing despite restrictions. Meanwhile, global corporations test blockchain-based payment rails to settle transactions directly, sidestepping costly currency conversions and delays. In Africa, mobile money apps blend with crypto wallets, giving millions access to global markets and remittances with a tap on their phones. But the rise of these digital alternatives brings new challenges. Regulatory uncertainty looms large, and volatility remains a concern. Governments worry about losing control over capital flows and financial stability. Cybersecurity threats, scams, and the environmental cost of mining add layers of complexity. Still, for countries seeking to diversify away from the dollar, the allure is clear. Cryptocurrencies and alternative payment systems offer a glimpse of a world where money moves freely, without a single nation calling the shots. Whether these technologies will transform global finance or remain on the fringes depends on how regulators, innovators, and the markets themselves respond. One thing is certain: in the quest to bypass dollar dominance, the digital frontier is no longer just a sideshow, it's fast becoming a battleground for the future of money itself. As the dust settles on the battlefield of digital disruption, the world faces a crossroads: multiple possible futures for the global financial system, each with its own winners and losers. Will the US dollar cling to its crown, propped up by trust, inertia, and the world's deepest capital markets? Or will a multipolar currency era emerge, where the dollar shares the stage with the euro, the yuan, and digital contenders. Some experts predict a slow evolution, not a sudden revolution. In this scenario, the dollar retains its dominance, but its lead narrows. Central bank digital currencies and stablecoins coexist with traditional money, making cross-border payments faster and more inclusive, but not dethroning the king overnight. The world becomes more connected, yet more fragmented. Money moves at the speed of light, but regulatory walls and digital borders rise. Others foresee a sharper break. Imagine a world where a major geopolitical shock, perhaps a new round of sanctions, a financial crisis, or a technological leap, triggers a rapid shift away from the dollar. Nations and corporations diversify their reserves, trade in multiple currencies, and settle payments on blockchain rails. The dollar's special status fades, and with it, America's unique privileges, lower borrowing costs, economic leverage, and political influence. But there's a third path, a world of chaos and competition. In this future, no single system prevails. Instead, global finance splinters into rival networks, US-aligned, China-aligned, crypto-powered, and everything in between. Capital and talent flow to the most open and innovative hubs, while others struggle with instability and exclusion. For ordinary people, this world brings both opportunity and risk, more choices, but less certainty. Which scenario will play out? Much depends on how governments, businesses, and everyday citizens adapt to the new realities of money. One thing is clear: the fate of the US dollar and the global financial order now hangs in the balance. The choices we make today will echo for decades to come,